Hi there. Welcome to our special edition of Commodities on BNN Bloomberg, the year in commodities. 2025 was a year that reminded us just how powerful and unpredictable the markets are for materials and natural resources. We saw record highs in metals, a sell-off in oil, a resurgence in Canada's LNG prospects, and mounting trade pressures on agriculture. We're going to break down the biggest commodity stories of 2025, and we'll look at what's ahead in 2026. We're going to be joined by three of the sharpest minds in the business. Pierre Lassonde, Chair Emeritus at Franco-Nevada, Eric Nuttall, the Energy Fund Manager at 9 Point, and Heather Exner-Pirro of the Macdonald-Laurier Institute. But first, let's just take a quick tour of how the commodity markets played out this year. It was tough to own oil. OPEC unwound its production cuts to maintain market share. And we did see a big rise in oil at sea on vessels. Of course, there were geopolitical risks. The ongoing conflict in Ukraine and Gaza did provide some support for oil, but as you can see, it's been a tough commodity to own over the past 12 months. Natural gas. Globally, there were signs of a slowdown in 2025, but the sector was anything but boring. After years of delays, Canada is made its entry into the global LNG market. And we're also getting word of a second LNG terminal moving ahead, opening the door to Asian markets. Copper prices hitting record highs. We had tight supply after major problems at mines around the world. And AI infrastructure is sparking demand for new electrical equipment and generation. And of course, that is hungry for copper. And in this country, we had that blockbuster merger in which Anglo-American took over Teck Resources, creating one of the world's biggest copper producers. And silver hit record highs as well, prices more than doubling to reach new records, as you can see, above $70 an ounce. Part of that is a persistent supply deficit, but there's also been consistent demand from green tech and technology. Silver actually beat gold over the year, but gold did just fine. It was a standout. It too hit records. Part of it, people looking for a haven in troubled political times. People worried, of course, about the potential devaluation of currencies with huge government debt loads and central banks trying to diversify their holdings, not to be over-dependent on the US dollar. And then let's have a quick look at the soft commodities. It was a tough year for U.S. farmers because China shut out American soy, although it later agreed to take large quantities of soybeans in a trade truce with U.S. President Donald Trump. The prospect of an end to the Ukraine war may add extra supply to world grain markets, even though Russian agricultural exports essentially have not been sanctioned. Uncertainty is not over, though, for Canadian farmers because this country faces a CUSMA review in 2026. Let's have a quick look at winning and losing stocks. And we're going to start off with the TSX Energy Index. Uranium stocks ruled. Look at Cameco up 70%. Among the losers in oil and gas, Vermilion and Paramount Resources. Turning to the materials, as you might imagine, the precious metals were on fire. Discovery Silver up more than 10-fold. Aris Mining up more than 4-fold. Methanex, the methanol giant, struggled. And it was a tough year for lumber with extra U.S. tariffs. West Fraser Timber among the big decliners. And then if we look at the TSX 60 index of blue chip stocks, Kinross trebled during the year. First Quantum came roaring back on hopes that its big mine in Panama will reopen. Pembina Pipeline was a relative underperformer, and Tourmaline was caught by weak gas prices. But let's bring in some expert analysis here. He's one of the the most respected names in mining. He's chair emeritus at Franco-Nevada. We are joined by Pierre Lassonde. Pierre, thanks very much indeed for joining us. Really appreciate it.
Always a pleasure. Always a pleasure, Andrew.
What a year for gold. I think we have a chart showing gold this century, and it's been a great asset to own. Although it got to records in 2011, as you know, and it was fallow for a few years after that. But certainly the gold fans have been vindicated this year.
Yeah, no question about it. I think that what we're looking at today is a situation similar to the late 1970s, when you saw the price of gold going from essentially $90 to $800 in a space of 3.5 years. And that happened in a context where you had, high inflation at the time, and essentially you had stagflation. And today, when you look at the U.S., particularly Mr. Trump's cornucopia of regressive tariffs, profligate spending, and eye-watering fiscal deficit, that's a toxic cocktail for more stagflation. And also, it brings into question whether the U.S. dollar is really a safe haven. And that's why you're seeing central banks buying, you're seeing the ETF, all of the gold ETF having record amount of input of incoming money. And I think that 2025 was a fantastic year, but 2026 is probably going to be a new record year again.
For similar reasons, you think those same forces are still at play?
Very much so, very much so. I mean, the U.S. has weaponized the dollar. And, nobody likes to get kicked in the nuts too many times, okay? So you look at China, well, they used to hold like 3 trillion of US dollars. Well, they've cut that, tremendously. And what are they doing? They're buying gold. And so are, Turkey, and look at the number of countries buying gold. It's really amazing. And so when you're buying gold, like half of the world's production is going into central banks. So that leaves only half, which is about 1,800 ton for everybody else. And if you're trying to move $1 trillion of saving into gold, the gold price will be like 17,000 plus.
Do you think there's a risk that we'll get gold mining euphoria, Pierre? We saw a lot of mergers during this year. Will we start seeing overpriced acquisitions, do you think, if this continues?
There's no question about it. I think that 2026 will be a record year for M&A in the gold space. The producers are getting incredible amount of cash flow. And while they are distributing a lot of it back to shareholders, they still have enormous amount of money left, and they all want to grow so I think you're going to see really a lot of new M&A in the coming year.
But look, we just saw how Kinross had a great year. But you remember years ago, they did an overpriced acquisition in Africa. That took years to work out. And we've seen that kind of thing in the gold market. Is there a risk that people will be bidding up assets too enthusiastically?
Of course, there's always a risk. But so far, the CEOs that have taken over after the crisis of 2011, 2015 have been very disciplined. If you look at Agnico Eagle, you look at Kinross, they've all been very, very disciplined, and I expect more of that. Now, does it mean that some acquisitions will have a 20, 30% premium? Yes, but you have to understand that, the stock today, are trading at like a consensus gold price of about 3,200 vis-a-vis the reality of $4,200 an ounce. So there's quite a margin here to play with for acquisition.
Big story in mining, Teck being bought by Anglo American. Pierre, you have expressed concerns in the past about the hollowing out of Canada's mining industry. Were you happy to see Ottawa approve that deal?
Well, in a way, yes, because it's the best deal that the Teck shareholders could get at the time. But no, because we're losing, in my mind, another champion of, Canadian champion. Yes, the headquarters have been moved to Vancouver, But 5 years from now, go to Vancouver and tell me whether or not the headquarters are still there. Because if you look at all the previous acquisitions, they've all promised, whether it's Inco, Alcan, Falconbridge, Noranda, they've all promised the same thing. And today there's none. So I'm skeptical, but from a shareholder standpoint, once Teck sold their coal division, it was essentially a rump, and it was going to get taken out no matter what. And I think that merger is the best that they could do.
Give us your thoughts, finally, if you would, on Mark Bristow. He's parting with Barrick Gold. In a way, he was far-sighted. I mean, he pushed getting big in copper. It looks like the African risk may have been the downfall. Investors just didn't enjoy that.
Well, I think there was several factors at play with his demise as CEO. One was his incapacity to look for accretive acquisitions. And because if you look at the 5 years that he was there, he did none. He was incapable. As I said to him many times, like, Mark, price is what you pay, but value is what you get. So why do you think, some companies are willing to pay a premium? Because they see far more value in what they're paying. But he was incapable of doing so, and he left on the table several, acquisitions that would have been great for Barrick. And at the same time, the performance was not there. Right. If you look at the guidelines, they missed, practically all their guidelines over 5 years, and the stock. When you look at what happened to the stock after he left, the stock doubled. And so there was a Bristow discount of 50%.
Yeah, he was stubborn, I guess, in the sense that he refused to do a premium takeover. He just didn't like those. Yeah, we'd better jump here. Thank you very much, and I hope you can come back and talk to us in 2026. Really appreciate it.
Well, I think we will have the opportunity to do that. Thank you so much.
Chair, thank you. Pierre Lassonde, Chair Emeritus at Franco-Nevada. Up next, we are going to put the spotlight on the energy sector and what lies ahead in 2026. Oil prices hit a 4-year low this month. It was tough for crude prices. Let's check in with longtime energy bull Eric Nuttall of 9 Point Partners. Eric, always great to talk to you. Thanks very much indeed. That's quite the fire you have going back there. Is that virtual or real?
Try to make it festive for you.
Oh, I love it. Is it real or is it virtual?
No, that's virtual.
Oh, beautiful. Tell us, a rough year for oil. What do you think weighed on the crude price this year?
Yeah, we were cautious on oil since about March of last year when OPEC made a pivot to decide to add on incremental barrels. It was very non-consensus at the time. Most people thought, given some of the uncertainties around the global economy, the U.S. economy with tariffs and such, that they would continue to keep those barrels at bay. That changed. And so the market has been grappling with how will it absorb it. The headline was about 2.2 plus a small baseline change for the UE. So headline was 2.5 million barrels per day being added onto the market from April to September. We now, with the passage of time, know that a lot of those barrels were fictitious. They were already in the market. So net adds are about 800,000 to 900,000 barrels per day from OPEC. We've got several 100,000 from Guyana, more from Brazil. And so short term, I do admit that the market is temporarily oversupplied. We've got inventories building both on the water and, more importantly, onshore, more than they typically would. But I think, importantly, we really should think about 2026, I think, is going to be a very, very good year for oil. Not the beginning. We do have headwinds. The market's got to absorb these incremental barrels. But a few of the dynamics that you and I have talked about for many times in the past are really going to come to force next year. We've got demand growing more than people would have thought. We've had this year the IEA saying, well, rather than peaking by 2030, demand's going to actually grow till 2050. The twilight of U.S. shale is real. U.S. shale production has barely grown this year. It's been flat for the past 3 months. We see no growth from U.S. shale. As a reminder to the viewers, U.S. shale has been over 100% of total non-OPEC supply growth for the past 10 years. And as U.S. shale matures, 2026 is forecast to be the last year of aggregate supply growth from both OPEC and non-OPEC. And so we see a structural mismatch beginning at some time in 2026. The world is going to wake up and realize we need exploration, we need offshore drilling, et cetera. And that does not work at 50s. It doesn't work in the 60s. And I don't even think it works in the 70s.
Eric, you and I have talked about Cenovus's takeover of Meg Energy. I think your thesis was the price could have been better.
It could have been.
But it was perhaps inevitable. Meg was in play.
Yeah, here you had the best quality asset in Canada, a spectrum of the market that remains out of favor. The small and mid-cap space, it remains very, very still out of favor. And so it was inevitable that a company was going to come along. We thought they sold prematurely. It was outside of the influence or power of the board. But we think it's in good hands. We think Cenovus is going to have a really good year in 2026. As they harvest the synergies of that asset, they continue to grow production. They've got a lot of their downstream issues behind them, and it trades at a material discount both to its Canadian peers and its U.S. peers. And what we see is U.S. money finally coming into Canada. We see that as investors are being aware that there's an inventory challenge for most of the U.S. shale companies, and we're starting to see a bid in the CNQs, the Suncors, and we think Cenovus can potentially catch up to a name like a Suncor trading at about a 1.5 discount.
You must be encouraged to see progress at last on getting Canadian LNG onto the world market.
Absolutely. It's took far too long, but here we are now. We think next year Shell will sanction phase 2. So Canada, we're exporting roughly 1 BCF a day. That's going to ramp to almost 2 BCF a day in 2026. We think that is going to narrow the discount that we're selling our gas for to about $1.10 a USD. That's a very, very healthy level. We are also bullish on natural gas in 2026 as both Canada and more importantly the United States build out LNG demand. U.S. will increase their export capacity by another 3.5 BCF a day. Exports to Mexico are increasing. And we also see strong increase in power generation. Areas like Texas, you have power demand up 5.5% year over year. And because of the lead cycle for nuclear, we think natural gas in 2025 has really gone from being a transition fuel to now a foundational fuel. So we're bullish on the headline natural gas price, and we're bullish Canadian natural gas as the discount should continue to narrow.
Eric, just looking at the performance of the 9 Point Energy Fund in the year, well, let's say year to date, as of the end of November, up 24%. Not shabby on a rough year for oil. Down a bit in December, but not too bad. You've held in despite a very weak crude market.
I thank you for pointing that out, Andy. Yeah, we've had a good year. I'm happy with the year. Like you've got oil down 18%. Unfortunately, our 3 top names this year get acquired. We had Vering get taken out by Whitecap in January. We had a very large position in Meg. We traded from 23 to call it 30 on the Cenovus takeout. And most recently, we had NuVista get acquired by Ovintiv, which we think will come to pass in early 2026. So that definitely helped. We also saw an underlying bid in energy in general. It does feel like the worst is behind us for the sell-off in crude. Again, we've got short-term headwinds, but it feels like investors are starting to look through, let's say, Q1 of 2026 to a lot of the more positive dynamics that I spoke about sometime in the second half of next year. And so if you truly, we're in a world where demand is going to continue to grow for decades to come. The world just lost the biggest source of incremental supply, and now we need offshore. I think if we do the show again next year, we did last year. I'm happy to be with you this year. 1 year from now, oil could be in the high 60s to 70s. And when you look at oil stocks and with the potential upside, this year was a good year. We remain bullish in the outlook for especially Canadian energy stocks for 2026. We think it's going to be another very good year.
Eric, thank you very much. And I know you have a bunch of little ones at home, and I hope they have a wonderful holiday and a wonderful Christmas. Thank you very much indeed. Eric Nuttall of 9 Point Partners. Up next, Heather Exner-Pirro of the Laurier Institute. She, at the start of the year, set out 6 conditions for Canada to get its act together on becoming an energy and commodity superpower. We'll get a report card from her after the break. Heather Exner-Pirro joins us now, Director of Energy, Natural Resources, Environment at the Macdonald-Laurier Institute. Heather, thank you very much indeed for giving us the time.
Yeah, of course, happy to be here.
At the start of the year, you wrote a piece, 6 Steps to Becoming an Energy and Resource Superpower. Just to gallop through them, build more pipelines, reform the Impact Assessment Act, go nuclear, earn Indigenous consent, encourage critical minerals production through defence spending, and address labour disruptions on the rails and at the ports. Progress has been made on some of those fronts, I suppose. I mean, the federal government reaching some kind of rapprochement with Alberta on pipelines anyway.
Yeah, well, I mean, a few of them have had progress. I'd say they've all had progress at varying stages. So, obviously we're closer to building a new pipeline than certainly I expected we were, a year ago. I thought Northern Gateway was dead as a doornail. It seems to be revived, and there's a plan, and the federal government is agreeing to it. But in addition to that, we are building Prince Rupert Gas Transmission. It got its approvals reapproved, and we're just waiting for the FID on Siliciums, which is what it'll feed. Mm-hmm. And Enbridge announced $400,000 in egress for its mainline, and Trans Mountain announced another $360,000 for it. So we are certainly getting more egress. The world certainly wants our oil and our natural gas, and we look like we're on track to get some more out there.
And the federal government, as I'm sure you saw, passed that bill, essentially empowering the cabinet to override all laws on projects, except the criminal code and a couple of others. But I mean, pretty strong language that they are willing to speed up projects, it seems.
Yeah, exactly. So, the problem with some of these, cancellations and rejections we had in the Trudeau years was it really spooked investors and who wanted to come back to Canada when you could have kind of the rug pulled under you. And so the idea of de-risking it, of not letting the policy be the barrier, was very important. We saw C5, the Building Canada Act, kind of Mark Carney's first signature bill. He hasn't actually used those powers. Nothing has been designated in the national interest, but he started the Major Projects Office. Overall, I have some quibbles on the policy, but it certainly gave investors an idea that Canada was back in business and looking for more investment.
The labour disruptions at ports and railroad services, apparently Nutrien cited that as a reason for not putting a new export terminal in Canada. The head of Unifor said, Nutrien's just engaging in a bargaining tactic there. But you do see this as a problem, the risk of labour disruptions in our infrastructure?
I mean, it's a huge problem, and it accounted for, I think, a majority or at least a plurality of labor action the past year, a year that saw more strike action than we have for several years. And we all knew this was a problem. It's a problem for farmers. It's a problem for miners. It's a problem for oil. It's a problem for everybody. But at least, I don't think a lot of progress has been made, but at least it's going to the top of the priority list. That it's getting attention, and even just last week, it was the transportation minister was at the Port of Vancouver, saying we're going to fix this and we're going to improve this bottleneck in our supply chain.
Heather, we'll have to leave it there. I'm sorry we didn't have more time, but really appreciate it. I hope you can join us again in 2026.
Thanks so much. Happy holidays.
You too. Heather Exner-Pirro of the Macdonald-Laurier Institute. Thank you very much for watching the show. Ryan Miller, the one and only, is the producer today, but normally it's Whitney Cunin. She creates this show, and we're wishing her a happy holiday as well. Thank you very much for watching. Up next, The Close.